3,
2,
1.
Buy down. That's what we're talking about today.
Welcome to the Utah Real Estate Show podcast, the show where two agents and a lender teach real estate best practices by talking through mistakes we've seen and made.
When I got my first house, the idea was, it was the first year I had worked at the company I was at. There was a high probability I'd get a job increase or a raise at my job. And so they were willing to say, okay, yeah, you can qualify for this. And then the next year came, and I was like, oh crap, this is hard. I did get a raise, but I felt a pinch. And then the third year, I was like, okay, I'm gonna be fine. And then it went up again. I was like, oh crap, this hurts. Hello and welcome to another episode of the Utah Real Estate Show. I am Tyler Cazier, Utah Real Estate Agent.
Jason Christiansen, mortgage lender.
Aric Wiszt, the Utah Real Estate Agent.
In today's episode, we are talking about 2-1 buy-downs.
Yes.
And other interesting fads in lending.
Yeah.
Talking about mortgage mumbo jumbo.
Yeah. The thing is, they've been around for forever, and recently they're like, whee! Everybody's like, oh my goodness, can you tell us
And why are they doing that right now?
Because rates are high and prices are high and people want payments low.
Yeah, they want a way to get in. I actually bought my first house on a 2-1 buy-down. And I thought I was like this sneaky, crazy, like under the radar loan. That
Sounds like it's something like a hopscotch game. Like
Yeah.
throw a little, you do a little 2-1, skip, get a loan, buy a house.
Yeah, exactly.
Well, let's break down what a 2-1 buy-down is. So, if only we had a lender here. Oh, wait, we do. It's Kilimanjaro Jason.
Ta-da!
And Jason is going to talk to us about, he's going to define what a 2-1 buy-down is, so that if you've heard this phrase and have no idea what it means, now you'll be able to tell all your friends and rub it in their faces how much you know. Go ahead.
Yeah. Okay, basically it's prepayment of interest done by a party other than the borrower.
In
Okay.
English, please.
Yep, because I went,
Woo! Okay, so check it out. So 2-1 buy down is a 2-year reduction of interest rate. The first year, you prepay 2% of interest. The second year, you pay 1% of interest. You pay this all as a lump sum.
$500,000 house, 5% interest rate. We're going to do a special 2-1 buy down.
Okay.
So what is in it for the buyer?
The buyer gets a reduced payment because the interest is prepaid for the first 2 years.
Who pays that interest?
Typically, the seller, but it could be anybody but the buyer.
It can be anyone but the buyer.
Note, this is an IPC, an interested party contribution. So this is seller paid closing costs. This means, and this is like crazy, we've all had to not worry about this at all. If you're doing a conventional loan with 5% down, your total interested party contributions, meaning someone putting money towards the costs besides the buyer, is capped at 3%. Okay? You put 10% down, you got 6% you can play with. If this is an investment property, 2%, right? So there's stipulations, and when we're getting into buy downs, you can hit those pretty quick. There's actually a 3-2-1 buy down, which you're pinging against those caps, right? Okay. So this is Tyler. I need you to remember. Maybe someone else take out their phone because we've got to get this number down. So on your 5% $500,000 loan, your principal and interest payment is $26.84.
That's the normal payment.
That's your normal payment. So in a 2-1 buy down, your first year, your interest rate is reduced by 2 points. Okay,
Right.
so instead of 5, you're 3.
Yes.
Which means your first year, you're $21.08. Don't type that in.
Saving roughly $500 on the mortgage payment.
$26.84, $575.97 times that by 12. You need to keep track of this number. $69.11. So that's how much it costs for the first year.
that's the seller's concessions that they have to pay.
Not quite, because the second year there's a 1 buy down.
Right. So they're paying $6,900
For the first one, you got that?
For the first year. Got it.
$69.11.
$69.11.
So the second year, rather than being 5%, it's 4%, which makes your principal and interest $23.87. So you
saving roughly $200 from the regular payment
right,
per month.
almost 3.
Okay.
So that's another $35.63, and we add that to the $69.11. Thank you for remembering that. So this 2-1 buy down costs $10,474.
That the buyer cannot pay.
Right. Otherwise, the buyer would normally be paying this monthly interest anyway, just stretched out over 2 years.
Right.
So the seller comes in and says, hey, buy my house. We want to make it more affordable. This is going to be nice. The buyer qualifies at the regular rate.
The 5% rate.
The 5% rate.
Right.
But the first year they're paying 3%, the second year they're paying 4%, and then they're at 5%. The investor, lender, doesn't care. They've got all their interest right up front.
Yeah, and they were qualified at the full amount.
Right.
Okay.
Right.
So there's some good things here, and there's some potential bad things here.
Yeah. Let's talk about it, because there are, for sure.
So the problem that I see is people go, great, I saved myself $10,000, $6,000. That was $600 that first year, a month. That's a huge amount.
That is huge.
Okay, and then another $300 the next year. So that's a lot off of your payment. So what do people normally do? They spend what they have. So you go buy a house and that first year is $600 less a month. You go and buy new furniture, new truck. That's a $600 payment that you now afford. Like, you legitimately can't afford that. But then the next year, and you go, oh shoot,
half my truck payments.
And then the third year happens.
Snap.
Now something's got to give. Now, granted, if you progressively progress up, that's great. But
that's the hope, right? Like,
that's the hope.
Raise.
Yeah.
Right.
When I got my first house, the idea was, it was the first year I had worked at the company I was at. There was a high probability I'd get a job increase or a raise at my job. And so they were willing to say, okay, yeah, you can qualify on this. And then the next year came, and I was like, oh crap, this is hard. I did get a raise, but I felt a pinch. And then the third year, I was like, okay, I'm going to be fine. And then it went up again, and I was like, oh crap, this hurts. And so for the first 3 or 4 years of my mortgage,
because you also have it also goes up because of taxes and insurance and stuff too.
Your payment typically will go up because the escrows, right?
Yeah. So now you have a lot more.
Yeah. I wasn't planning for any of those. I was planning for the increase of the interest
in your
rate.
mind, it was good.
On paper, it made sense to me.
Yeah.
In my head, it made sense to me, but I didn't plan for the escrow increase. And when the escrow did increase, I was like, oh, this hurts.
Then you have another kid, and your wife says, oh, let's go to Spain.
So can you use these on investment loans, or is this primary residence only? Because is this a QM loan or a non?
You can do this on QM loans.
Okay.
Just topic for another day.
Okay, another day. Next loan.
Channel it.
But can you do this on investment loans?
You could.
Because that seems very enticing on an investor.
Get in, get started. You're going to up your cash flow by $600 a month for that first year. Even the second year, and shoot, by then rents might go up, and if they don't, you sell the house. Yeah, you could. Well, so this is one where know what you're getting into, because the other thing is plan. Discount points. Mm-hmm. Let's talk about the difference, right? Okay. Discount points on average are 1%. For that 1%, so on your $500,000 loan, your 1% discount point is $5,000.
Yeah, $5,000.
Right. So if you got 2 discount points, it would be $10,000. The same cost roughly as a 2-1 buy down on the same loan, right? But the discount point is a permanent reduction to the interest rate. However, your 1% discount point typically buys down your rate a 1/4 point. So it doesn't reduce your payment as much, but it reduces it for the whole 30 years. Forever.
Well, and the question comes then.
Can you do that payment right now?
Gee, I don't know with all this pressure.
While he's bringing that up, the question becomes, how long are you going to stay in your house?
And do you know?
How often do we run into this exact same question when we're looking at a property?
We have
all
it
over the place.
Well, that and one of the biggest pieces of advice that we got just when we were talking about investment homes, they kept saying, do not buy an investment at best case scenario. Do not buy best case. Do not buy best case. Buy conservatives, worst case, and then hopefully it goes this way. This is that same thing. If you bank on going, well, I have to have this at this, well, then you probably shouldn't buy that house or that amount.
Or if you're looking between a buy down and a discount point, and you can make it swing either way, discount point's permanent, buy down's not.
So if you're going to be in the house for 3 years, 2-1 buy down. If you're going to be in the house for 10 years.
So what's the payment? I have the old one.
$2,684, right? You're doing a buy down. So one buy down takes you to 4.75. Reduces your payment to $2,608. So you're saving
80
almost $80.
Yeah.
You do another discount point, take you down to 4.5. Oh no. Tapped it twice. You're at $25.33. So $150 less.
Yeah.
So not a substantial savings,
But a permanent savings.
but over the life of the loan.
Yeah, your payment's not going to jump up $600 in 1 year and then another $300 the next year.
So this is
So
the same thing as ARMs, right? After 08, 09, there was a huge perception in the market that ARMs were bad. ARMs were what lenders used to sink people and create the mortgage meltdown. No. An ARM is an adjustable rate mortgage. A lot of people who made it through the mortgage meltdown loved their ARMs because as the interest rates crashed,
And brought their payment down.
their rates went down.
That's a beautiful thing.
Yeah.
Have your mortgage get cheaper over time.
Right. So the one other like magic thing deal we can do is a single premium MI. Okay. So
MI is standing for mortgage insurance.
mortgage insurance, yes. Mortgage insurance. This is some people get really mad at mortgage insurance. I love mortgage insurance. They're like, oh, it's a waste of money. What it does, it gives a buyer an opportunity to buy a house, giving the investor security in the event of foreclosure that the investor can be made whole. So, minimum less down payment than 20%.
Right.
Buying a house is made possible by mortgage insurance. So you're paying a small premium to ensure the lender that in the event of foreclosure, they will be made whole. Okay. So they want a set amount of money. The most common way to do this is monthly, right? And you're based on risk, credit score, debt to income ratio, how many adults are occupying the home with incomes that you're counting, all affect your mortgage insurance rate, okay? Typically, if you take mortgage insurance payments times by 48, like 1 month times 48, you'll get roughly the amount of a single premium MI. Mortgage insurance typically is on a home 8 to 11 years. So if you pay it all at once up front, you're going to save $100 to a couple $100 a month.
And 7 years of mortgage premium
If you live there.
for that long.
Right.
Curious. So can I just walk into my mortgage broker and say, hey, I want to do a single premium MI? And they'll know exactly what I'm talking about? And that's for any loan. I could just pick out a loan and say, I want to do this.
FHA, no.
FHA, no.
No, because it's
So-
different, right? USDA, no. Conventional loans.
Conventional
loans.
Okay. Well,
And
that's a
they
good
should
tip.
be able to.
Yeah.
That's
And how do they calculate
now that can be paid by the buyer.
yeah.
And
Buyer, lender,
same
seller.
with discount points.
Yes.
The only one that the buyer can't touch is the 2-1
Buy
down.
down.
And there are ways around that a little bit, but that's inflating numbers to pay for numbers. But the buyer can't come out of the buyer's pocket.
But if the seller is trying to move a property
That's a good way to do it.
and they say, so it's really interesting if they say we'll give you $20,000 off the purchase price, we're just going to drop it, we're going to sell it, we're going to move this property, the payment will actually be higher for the buyers than if that same seller was to say we will give you $15,000 seller paid costs and another $5,000 for whatever, right? So if you're doing a discount
Smart
point,
way. Yeah.
you've got $10,000 to buy down 2%, right? And then another $5,000 for who's whatever, right? Or like, and you throw some into single premium MI. The buyer will spend less per month. The seller will end up with more money in their pocket, and both agents will end up with
Can
more
you do
commission.
discount points and single premium MI on the same loan?
You can't
And
do
2-1 buy down? Can we get the whole board?
you just play it all at once. You might run into problems there. I've never tried to do a discount point
So it
and a buy down at
can
the same
maybe?
time. It's possible. It's
All
possible.
right, I
You're
like that. So they're saying there's a
bending my brain.
chance.
That's right. That's right. So, what did we learn?
My key takeaway is that I can walk in as a buyer and express my desire to never pay mortgage insurance and pay it all up front as a single premium MI.
Never pay monthly. I like it. Know that there's options, and reducing the price isn't always the best option.
Remember to seek out professionals and ask questions. You wouldn't have known about any of these if you just went and asked a lender or a broker online or whatever. They would have just given you a number.
Snap. Yeah. You're pre-approved. There you go.
Yep, there you go.
Folks, thanks for watching. Please consider sharing this valuable information with your friends, family, relatives, and
sellers, buyers, investors,
neighbors, cousins.
in addition, comment, like, share, subscribe. If you don't, the Tooth Fairy won't collect your teeth anymore, and your true love won't show up in the mailbox at midnight.
If you want to get in touch with us, shoot us a text at 801-228-7687. Make sure you mention the show. You can email us at theutahrealestateshow@gmail.com. You can watch this show on YouTube, and you can listen on Apple Podcasts, Spotify, or wherever you get your podcasts. If you learned something, or if you really love this show, give us a like on YouTube and drop a rating on Apple Podcasts or wherever you listen. The Utah Real Estate Show is a production of Hive Collective at Presidio Real Estate with support from Security Home Mortgage. The NMLS number for Security Home Mortgage is 178787. The NMLS number for Jason Christiansen is 240472, Equal Housing Lender. Not only is this not legal or investment advice, but you should definitely talk to a pro before you make any real estate decision. Every situation is different and should be considered in context. Copyright Jason Christiansen, Aric Wiszt, and Tyler Cazier. All rights reserved. Talk to you next week.
talking about that stuff. That we
Good evening and welcome to another episode. I am the Utah Real Estate Show. Minimum wage.
No, let's
yeah.
Until you say that's what we're talking about today. Do that, yeah.
3,
2,
1.
Buy down. That's what we're talking about today. Good job.
Finger guns.
What are you guys doing?
3,
I thought that one worked.
3,
2,
1.
Buy down. That's what we're talking about today.
Seriously, you can't do the...
No, it's this. Isn't it Minnesota as well? Minnesota?
Milk.
Milk?
I
I
don't
love
know.
milk. Okay. Ka-chow.
All right, what's our out?
Ka-chow.
Ka-chit.
If you fall down in your driveway, you can't complain. You know why?
Why?
Because it's your own asphalt. Your true love won't show up.
Don't you remember those chain letters?
Nope.
What? But if you stop it, we won't have an out.
We just did the out.
Oh, we're keeping that?
Oh, sounds good.
Okay. Why not?